Yeah, I've been managing the bonds Universalis Unconstrained for almost 11 years today, and it has been actually a spectacular journey because we have been actually treated very well by monetary policy over the past 10 years, which was very an activist policy. So it dominated the trend to the downside in global rates. So effectively running an unconstrained fund allowed me to really combine long-term convictions with medium-term accents and polish the portfolio construction with short-term alterations of the positioning across rates, across my currency exposures, and across credit spreads. So essentially, the Universalis Unconstrained offers you a very broad opportunity set to source bond risk premia in a very flexible but very researched manner, and that has been a key element in the success of the fund over the past 10 years. So it's unconstrained in this huge opportunity set that we can invest in, but on the other hand, we always applied a very constrained risk control and risk management by applying a value at risk approach across those risk factors, FX, rates and credit spreads, and we never over a 1 month horizon crossed the 3% maximum value at risk that we abided by. And we did it at a 90% confidence interval, so meaning that 10% of the time, or a bit more than a month, a year, a calendar year, we were hitting our value at risk budget. So, but that's the edge. It's unconstrained, focused on sourcing very liquid bond investments in government bonds, in credit, be it developed markets, be it emerging markets, or be it an investment grade, low risk, quality corporate bonds. In high yields, at times there are opportunities, but we limit it to about 10%. And also in subordinated debt, we are very wary and I would say severe in the selection, because whenever volatility picks up, we don't want to be disturbed, and you've seen that in, I would say, over the past 10 years, we nearly reached a 6% year-over-year return for about a volatility profile, realized volatility, just above 5%. So that puts us, quite well against, the peers that I very much respect. I just mentioned that we try to combine the longer term views with the medium and short term views. So longer term views, there are two elements that are actually playing out for the moment. So there's globalization put on hold, and within this context we've seen that this globalization put on hold dates not from 2018 with the US-China, but we've seen that it actually started right after the great financial crisis, early 2010-2011. So in this context, what was key was that the US dollar, as one of the, I would say, components that we use in order to generate returns, has been strengthening. So the dollar, we believe that the dollar, in a context of stalling globalization and regulation, will have an upward bias going forward, next to the fact that we believe that money supply growth and base money growth by the ECB, induced by the ECB, will be at the margin stronger than, I would say, money supply growth in the US by the Fed, whereby, at worst we expect a consolidation in euro-dollar, and at best we see a continuation of, I would say, the euro depreciating versus the US dollar. And the second element, which is very important, is that we had persistent disinflation. Headline inflation in Europe has been running about 1.2% over the past 10 years, whereas in previous decades the ECB reached their mandated price stability target just below 2%. So we believe that given salary inflation, wage inflation that is really picking up, and underlying inflation trends in Europe which are actually very supportive and around 1.5% today, that both combined will make inflation expectations go up over the longer term, 3 to 5 years out, and that is not, I would say, priced correctly by markets, where the measure used by Draghi often, and the five-year forward inflation swap indicator, is currently around 1.2%. We believe that over the next, I would say, episode into the next decade, that this indicator will, given very, I would say, accommodative monetary policies on a global scale, will start to normalize to the upside. And that brings me to those two elements is we will always have in our set of in our portfolio construction a good dose of exposure to US dollar markets, mainly US tips. It's about 10%, and on the other hand, for about a quarter or a bit more than a quarter of the portfolio construction is invested in inflation-linked bonds, and this occurred effectively over the past 3 months. So in terms of my rates outlook, because people are very anxious with a lot of paper in global bonds, in negative yielding territory, so there I believe, being a bond bull investor for the past 10 years, that we are in a transition period, because you will have monetary policy combined with fiscal policy, and the complexity of that situation will, I would say, push markets to value an extra a bit more term premium. So I expect effectively that over the next episode, I'm not talking about tomorrow, but over the next couple of years, that the negative, I would say, Bund yield curve will go back into positive territory on a steepening basis, especially on the 10-year point. And effectively that in the US, you might expect some support at the short end, because markets are expecting another 2 rate cuts, which we completely, I would say, will not fight, but we do not see the Fed lowering rates way below 1%, because that would corner other central banks, and it would give the wrong messages to markets and to society as a whole. So there we expect more like a steepening, a slight steepening with a pivot around the 5-year point. So I think the jury is out, but we might be in over, I would say, the next 3 to 5 years for a normalization of the global rate complex. And in that respect, one has to be careful not to be taken, I would say, too long duration. Duration for the moment, I lowered it from about 7.5 years to currently around 5.5 years. But if rates would pick up, normally our exposure to the rate risk factor will drop even more, and below 5 and even 4 years.